Morning. Top Gun here, 10 after 4 a.m. on Saturday, March 13th. This is going to function as the YouTube pre-market commentary for Monday, March 15th. All right. Section 1, 10-year yield jumps 11 basis points, but stocks shrug it off. So the 10-year yield skyrocketed higher yesterday to 1.635%, which is a 72 basis point move just this year, and 11 basis points in just one day. And that was the catalyst for the 3-week correction that we saw, especially in growth and tech stocks. However, the market yesterday just pretty much shrugged it off. It sold off pretty hard at the open, but it found a low within about an hour. If you look at this intraday chart of the NASDAQ that I've included in the blog, and we just rallied the rest of the day to close down only 0.59%. The S&P was up 0.10%, and the Russell 0.61%. Just shrugged it off yesterday. So the idea is that rising rates won't kill the bull market, because they'll just cause a rotation from growth into value. So I've quoted from Al Roots, the trader column in this morning's Barron's, and he says, look, rising rates are the reason for the volatility, but higher rates aren't a signal that investors should sell now. The market could well rise higher still. The stocks leading the market, however, might be a little different than the ones that led it to records in 2020. And then he talks about the financials and the industrials seeing their estimates being increased by analysts compared to tech companies. So this rotation into value is supposed to keep the bull market alive. But as I've argued many times, value is not a big enough proportion of the market capitalization of the major indexes to drive it higher if growth has topped, which I believe it has. In addition, the value has run extremely. It's run quite a bit already, as people have piled into the reopen names. So the valuations there are extremely full, as we saw yesterday with Ulta, and I'm gonna talk about Lyft in a second. So nevertheless, I made a mistake in including the IWM, which is the Russell 2000 ETF, in my the initiation of my short campaign on Thursday. I have 15% short ARC, 7% short QQQ, 7% short SMH, the semiconductor ETF, and 7% short IWM. But what happens in bull markets is that one leader tops after another. It's a process. Bottoms are an event, tops are a process. Lowry's research has a great paper on this called The Nature of Bull Market Tops. Just go to their website and get this paper, and you'll see. So one stock or group of stocks tops after another. So I think tech is now topping, but value has not topped. So it's not time to short the IWM, even though fundamentally it's extremely overvalued. As you can see, almost 35% of stocks in that index are unprofitable. So one great example of a lot of the stocks in the Russell 2000, one that's actually in the S&P 500, is Lyft. Now, Mark Minervini put up a tweet yesterday that he's long Lyft, and he's doing very well with it because the stock has tripled in the last 4.5 months. But this has nothing to do with the fundamentals. Lyft's active ridership was down 45.2% in the fourth quarter of 2020, and it lost, let's see here, $185 million in the quarter, and close to $1 billion for the year. So, if you're taking into consideration fundamentals, you can't invest in Lyft. So what's happening is people are forecasting that the reopening is going to be really good for their business, but that hasn't shown up yet in the fundamentals. And in fact, it's already probably priced in. So if that event materializes, well, the stock's already priced it in. So, the CFO said the first quarter is going to be tough, but we expect to see a growth inflection point beginning in the second quarter. based on current recovery expectations. So this is not based on any data in as far as his business goes. It's just based on what the sentiment believes about the reopen. And that was enough to push the stock higher after its fourth quarter earnings report on February 9th. On February 10th, it jumped higher. So, but the IWM is not yet ripe for shorting, but it will be soon. Okay, moving on. So we talk about stock markets all the time, but in fact, real estate is a larger source of wealth for our country than stocks and financial assets. Real assets are, the majority of which is real estate. Mike Bird had a nice Heard on the Street column in yesterday's Wall Street Journal about this. And what my point here is that rising rates are even more negative for real estate than they are for stocks, or they're at least, I think because you use leverage in real estate, rising interest rates are extremely negative, maybe even more negative for growth stocks, maybe similarly negative to what I call speculative growth stocks, like the stocks in Cathie Wood's ARKK portfolio. So, these rising rates, this is a very, very interest rate sensitive market and economy. So, we shrugged it off on Friday, but I don't think that we can for forever, indefinitely. Okay, lastly, nice article by Michael Worsthorn in yesterday's Wall Street Journal about the ARK Innovation ETF, or ARK in general, but especially the ARK Innovation ETF, where he points out that 36 of his 56 holdings were unprofitable in their last fiscal year. So they should be, with their whole valuation being based on earnings out in the distant future, they should be extremely, extremely sensitive to interest rates. Now, they didn't get hit too hard yesterday, but they really should have, and they're extremely sensitive to interest rates. And they broke it down technically, so that's that my 15% short in ARK I am happy with and will hold, given everything goes according to plan. All right, I will see you guys next week. Have a great weekend.